So can I beat the stock market using the magic formula investing strategy? In today's video, we're going to find out more. So straight away, you're probably asking, what is the magic formula? I come across the principle of magic formula investing from a book called The Little Book That Still Beats the Market. I'll put a link to the book in the description below. The book is by a very successful hedge fund manager called Joel Greenblatt, who claims he's made a screener that can find undervalued stocks. This stock screener that he's created is looking for two key metrics. Number one, a low price to earnings ratio, and number two, a high return on capital. Now, of course, given time, we could look for these stocks ourselves. However, Joel Greenblatt has created a stock screener that does all of the hard work for us. In his book, he claims that using his investing strategy and the screener, it can outperform the stock market. Now, I'm not going to go into any more detail of what the sort of rules of my challenge are. Instead, I'll link to the first video I created in the top corner. That explains what exactly I'm doing, how much I'm investing. To give you a very quick summary, basically I'm investing £50 into two different companies, so £100 in total every single month. Today, I'm going to buy two more stocks, and then I'm going to go through all of the previous stocks that I've purchased. So first of all, we're going to head over onto the website, onto the stock screener, and find this month's two new stocks. So I'm now on the Magic Formula Investing website, which is magicformulainvesting.com. We're going to head over onto the stock screener. We're going to change our market cap to 300 million, which I explained why in my first video, and we're going to hit get stocks. It's now going to throw out some suggested stocks that it believes are undervalued companies according to those two main metrics I was telling you about earlier in this video. Now, the two stocks that I've decided to invest my money in this month are right down the bottom, and it is Tupperware Brands Corporation and Sage Therapeutics. So I'm just going to quickly use this website, Simply Wall Street, to take a closer look at both of those stocks. So for any of you that don't know about this website, I'll leave a link in the description below. So first of all, it was Tupperware Brands. So it's saying that currently they believe that it's trading at 58.8% below their estimate of fair value. Their earnings are forecasted to grow, which is always good news. Their earnings grew last year by 738%. One of the risks that has come up is they have a high level of debt, which is obviously not the best news. Simply Wall Street do give so much more information. I won't go through all of it today because I don't want to make the video too long, but feel free to sign up. You can get a free plan and you can look at up to 5 companies per month on your free plan. Next up, we'll take just a very quick look at Sage Therapeutics. There they are. So these guys are saying they're trading at roughly 83.3% below their estimate of fair value. It's very important for me to emphasize it's only their estimate. They become profitable this year, which is obviously good news. The risk analysis says that the earnings are forecast to decline, which is a bit of a worry, and shareholders have been diluted in the past year. So using all of these various different websites, you can make a decision whether or not you wish to invest in these stocks or not. As part of my challenge, I'm going to continue through. I'm going to head over onto my phone now and buy both of them. I'm now on Trading 212. This is the page you'll see when you log in. You can see I've got £100 worth of free funds ready to go. So we're going to search each of these companies. So the first one was Sage Therapeutics. So we can search Sage and we're looking for, there they are, Sage Therapeutics. We're going to buy, and we're going to buy £50 worth of value. It's very important that says value and not number of shares. So that is going to buy us roughly 0.9 shares. We're going to hit review order, make sure everything's correct, and hit send buy order. There we go, order executed already. The next one we're going to buy is Tupperware Brands. So there they are. Again, we're going to hit buy, make sure value is selected, and choose £50, which is going to buy us roughly 2.6 shares. We're going to hit review order, make sure everything's correct, and send buy order. There we go, that one took ages. I'll cut that out in the video, but it's all executed. So those two stocks have now been purchased. Now let's take a look at the previous stocks I've bought over the last few months and see how they're performing. Before today's update, we were 7 months through, so obviously I've purchased 14 stocks so far. So the first stock I ever purchased was Biogen. Now from the £50 that I invested, it's now worth £45.47. They unfortunately had some bad news come out about them just after I invested, typically, about either a drug being deregulated or something like that. So that means overall they are 9.06% down. The second stock I purchased was Catalyst Pharmaceuticals. Now again, they had very similar bad news to Biogen. The £50 I originally invested is now worth £42.65. So I'm down on those guys by 14.7%. I must say with Catalyst Pharmaceuticals, they have made a bit of a rebound over the last few months, as they were really down at one point, I think as much as almost 40%. The next stock I purchased was Discovery. My original £50 investment is now worth £90.04. So that is up overall 80.08%. Now that sounds incredible, and it is incredible, but what I must add is they have had some massive drops recently. At one point I saw that stock reaching almost 200% up since I purchased it. So to be only 80% up now almost seems disappointing, but of course overall it's great news. Next up I purchased Hewlett Packard. Now from my £50 it's now worth £77.40. I have received a dividend on this one of 41p, which wasn't enough to reinvest it, and the total change including my dividend is 55.62%. Next up is Cisco Systems. From the £50 I invested, it's now worth £62.24. Again, I've received a dividend of 37p. It wasn't big enough to reinvest. I am up overall 25.22%. Then I purchased Weight Watchers. My £50 investment has grown to £64.44, and overall I'm up 28.88%. The next stock I purchased was Buckle. My £50 is currently worth £78.43. I've also received a dividend on this one of £3.41, which of course was the first one that's been big enough for me to reinvest. So including my dividend reinvested, I'm up 56.86%. Next up was Renewable Energy. £50 is currently worth £56.28. These guys have also dropped recently, as I was up quite a bit at one point, I think by about 70% or so. However, I'm currently still up. I'm up by 12.56%. Next up was Fox. From my £50 investment, it's now worth £59.48. So overall with them, I'm up 18.96%. Then there was Viacom CBS. My £50 has become £62.17 currently. I've received a dividend on this one of 28p, and in total I'm up 24.9%. Next up was Best Buy. £50 has become £56.23. No dividend on this one, and I'm up 12.46% overall so far. Then I purchased Turtle Beach. £50 is now £57.02. Overall, I'm 14.04% up. And then finally, onto last month's two stocks. The first one was Barratt Business Services. £50 has become £52.71, which means I'm up 5.42%. And then the second stock I purchased last month was Endo International. My £50 is currently worth £41.88, which is a loss overall of 16.24%. So moving over onto the right hand side of my spreadsheet, you can see before today's update I'd invested £700 of my own money. My £700 is currently worth £847.50. That gives me an overall change of 21.07%. Now this change is brilliant, however it is down. The stock market has been pretty wobbly recently, and I've definitely noticed it with some of my stocks massively dropping, like Discovery and also Renewable Energy. So it'll be interesting to see how the update is over the next few months and what the stock market's going to do too. So part of the magic formula investing strategy means you have to sell the stocks after a year of owning them, regardless to how they're doing. There is one exception of that, and that is if they still appear on the stock screener. You can then decide if you wish to keep them. So here is my second spreadsheet showing all of the stocks that I've purchased so far, the dates that I've purchased them, and most importantly, the dates that I have to sell them. Now, hopefully I'm going to make a profit, and those last couple of columns are going to have some nice tasty profits in, but we shall see. The first two stocks that I will be selling are obviously Catalyst Pharmaceuticals and Biogen, which are due to be sold on the 27th of July this year. Now, I must say both of these stocks are still currently listed on the screener, so it'll be interesting to see if they're still on the screener when I come to sell them in July. If so, I think I'll probably hold on to them. Now finally, let me know in the comments if you think this strategy can outperform the market. I'll be really interested in hearing your thoughts. Now of course this is just for a bit of fun, and the money I'm investing is money I can afford to lose completely. So please don't copy me, please only ever invest what you feel comfortable in, and ultimately something you can afford to lose just in case anything did go wrong. Apart from that, I hope to see you on another video very soon. Take care guys.